This is the Daily Market Rundown live from the Tradelo trading floor. It is May the 12th. Some highlights from today's show. US stocks bounce on peak optimism. Gold is set for a multi-day sell-off, and the euro-dollar still proves to be a safe haven. Good day, traders, and welcome. Happy Monday to you, which is likely to be a very eventful week again. Let's get straight into the overnight news and talk a little bit about what has actually been announced from the US and China situation. Now, it's very much been a scaling back of tariffs, a lot more than I think what most people expected, including myself. I thought that the play, at least what the market was pricing, was they would bring things back to pre-Liberation Day levels, that 50-odd% that Trump put up on his Liberation Board. Now, they've gone a little bit further than that, pretty much agreeing to put tariffs or set tariffs at 30% for the Chinese and 10% for the US. So a little bit lower than that pre-tariff day. But this is the key, is that don't forget, pretty much everybody that the US retaliated against had their tariffs set at 10%. Okay, in other words, ultimately, China is even higher than what everyone else is, given that Trump gave everyone a 90-day extension. Okay, so this is quite key. It's quite important just to be aware of, is that there was quite a big scaling back, but at a sort of, if you just take a massive step back and look at the big picture of things, it's still a lot higher than what everyone else has received from the US. Okay, now moreover, let's just remember, this is not agreed, this is not signed, this is nothing other than a temporary discussion where they've agreed that they cannot afford ultimately to allow things to go on as expected, because ultimately they both recognize if they are to keep going as is, they could effectively, pretty much send both their economies into a recession. Okay, so that's the key takeaway, is this is done more just to safeguard an imminent recession, but keep in mind, this is 90 days. Okay, they've got 90 days now to somehow discuss how they are going to keep, tariffs at the 30 and 10%. Okay, now, if you were around in Trump's first term, what ultimately happened at a tariff level was they went on for about 18 months before any kind of terms were agreed to. So these trade deals don't happen overnight. What I expect is going to happen, and Besant has already alluded to this, is the Chinese are going to now be handed a list of things that they need to buy from the United States, and the same way that they agreed to that list back in 2017-18, they'll most likely agree to that list moving forward. The problem this time around, however, is that they're always going to have that threat of higher tariffs around their neck. Okay, the point is that moving into the next 90 days, this is going to be a tit for tat, where it's going to be either you accept and buy this much, otherwise the tariff needs to be at 40%. If you don't adhere to it, we're going to put the tariff at 50%. And it's going to be this backwards and forwards. In other words, this is by no means a certainty. And that's the key thing to take away here, is that there's very little certainty that's been given to us other than a bit of reprieve. Okay, and that's why I've termed this as, this is, or what seems to be, peak optimism. This is as good as it is going to get from a tariff perspective, because remember, we still have a host of other massive important countries that now need to negotiate tariffs. The likes of Europe, okay, the likes of Japan. These are massive trading partners that we have seen no progress. And don't forget, that clock is ticking. We've got just around 50 days to go until we're supposed to see these magic deals coming out of nowhere, okay? And that's the key theme for today, is that whilst the markets are ripping up the page, don't forget now, this is as good as it gets. In other words, what do I mean as good as it gets? Well, let's take a look at our scale that we've been talking about over the monthly, over the daily rundowns over the last couple of weeks. Pre-China announcement, we were sitting around 20.5%. That was the effective tariff rate the US was charging on the globe. Okay, start of the year it was at 2.5%. Given the assumption that China is going to be tariffed 30%, and ultimately the US effective tariff rate is now 10.5%. Okay, we started the 2.5, we're now 10.4. Now you have to ask yourself, do you think that China will be able to get a tariff lower than 30%? I think the short answer is, if we're going to assign probabilities, we'd say 90% likely they're not going to get less than 30% unless they're going to agree to buy everything from the United States. Okay, and that's the point. This 10.4% is pretty much as good as it's going to get from this point forward. Okay, because now ultimately, are we gonna see Europe just agree to everything the US says? Are we gonna see China just agree to everything the US says? Of course not. Okay, so in other words, the probability starts to move more towards the right now. In other words, the effective tariff rate that we might land on 3 to 6 to 9 to 12 months from now is probably going to be not lower than 10.4, but probably slightly higher than 10.4. Okay, is it going to be 20.5? Absolutely not. Okay, we shouldn't go back to those levels, of course, unless we go to an all-out trade war, in which case all bets are off and we will go into recession. The point is that we're starting to narrow the range of possibility of where that effective tariff rate is going to be. Okay, think somewhere between 10.4 and 15%, which is what the market now needs to price 12 to 18 to 24 months from now. Okay, remember, markets are forward pricing mechanisms, so they want to try and price this out into a future date. Okay. Now, in terms of some of the recession odds, we can see that's coming quite dramatically. And this is key. The recession odds are still around 44%. Okay, so we still have effectively almost an even odds bet that we will form into recession. Of course, it's perhaps not 50% anymore. That does seem to be slightly improving, but there's still a very high probability of recession. In other words, the market has to price in that recession. Okay, and that means that going back to record high territory for US stock markets is not likely to happen unless we get a re-acceleration of hard data in the US. Okay, and that's the key takeaway, is that we are now in a situation where things are looking better. But don't forget, we've priced in that looking better over the course of the last couple of weeks, because we had peak sentiment where things were completely negative and the markets were falling off a cliff. Now we're on the other side, which is it's peak optimism. This is as good as it gets. And now ultimately we actually have to see some deals. Okay. Now, in terms of what has moved, what hasn't moved, I think there's a couple of key lessons we can take here. Starting with the yields, we can see yields are quite a lot higher, quite a lot steeper. And again, don't forget the inflation genie is still very much a problem, and we'll talk about that in a moment. But right now, the Fed is on pause. The Fed is not going to be able to cut rates anytime this year. And ultimately, if anything, this sort of stance of 30% tariffs on China is only going to prove to be inflationary, and it's not going to tip the US economy into an imminent recession. So it is going to keep the Fed's hands very much tied. Okay, commodities have done particularly well in terms of crude. We know that has been very sensitive to a global trade war, and we can see obviously gold giving up 3.5%, which really does tell us how much of a safe haven bid was in the gold. But we'll talk about gold in a minute when we get to the charts. If we then look across at the currencies, there's some really good takeaways here. Have a look at how the euros performed against the Swiss franc. Okay, we can see euros up 0.4 against the Swiss, which really does suggest that the Swiss and the Japanese yen were the ultimate safe havens, and ultimately the euro was still somewhat of a safe haven, and it has pretty much held up quite nicely against the Swiss franc. Okay, if we compare the euro to the pound, though, notice how the euro is down. In other words, in terms of order of ranking, what was bought as a safe haven, it was Swiss, it was yen, then euro, then ultimately the pound and all the other likes. Okay, and if we go to the opposite side of the spectrum, look how the Aussie dollar is traded today. Okay, very, very interesting sort of spectrum of thoughts here. Don't forget, of course, Australia is very closely linked to China, and that's why we are seeing the Australian dollar hold up so well. Okay, it's almost like this deal is much, much better for Australia given their trade dynamics with the likes of China. Okay, so we can learn a lot of lessons, which is, in terms of when that potential trade escalation starts again, when we start to see news flow come back about Europe deals and all that sort of thing, don't be surprised, or make sure you know what those safe haven assets are and what are the markets most sensitive to escalation. Now, with that in mind, I think this is a fantastic chart to talk about peak optimism and peak negative sentiment. And we're going to kind of go and sort of put the peak negative sentiment here in terms of where we traded down to. And in terms of optimism, we're going to put it up here at the top. Okay, why? Well, because if we look where Liberation Day was, we started around that 5,700, and going into this, we knew there was going to be some sort of a tariff coming. We didn't know what it was. We knew there was a couple of options. They were talking about a blanket tariff. They were talking about retaliatory tariffs. They were talking about all sorts of wonderful things. Okay, the point is, we knew there was a tariff coming pre-announcement. That tariff did come eventually, and we can of course see that the markets then overreacted because it was a lot bigger than expected. Okay, we then had peak negative sentiment, market sold off, and we had the 10% day where we got the 90-day extension, and ever since then the market's been grinding its way higher. Okay, now we're all the way back at this key area, 5840, 5900. It's a massive area of resistance. We can see how it acted as previous record highs, previous support, previous support, previous support. It came down, acted as a barrier of support, then it turned to resistance. This is the first time test here between 5840 and 5900 on the futures. This is going to be absolutely important. And like I said to you, just because we've got some sort of an extension of 90 days does not mean the market's suddenly going to now go massively risk on and trade back towards record highs. Okay, you're going to need some really good data coming out of the likes of the US, some really good hard data, coming out of the US before we're going to break above this 5840 and 5900. Okay, from a tactical perspective, from a risk-reward perspective, it makes absolute sense now to build that short position, to expect, and this is the key, to expect that things get slightly worse from this point rather than better. Why? Because like I said to you, Europe is not going to roll over and just give the US everything it wants. China is not going to just agree to the US's bucket list of goods, go buy them, otherwise you're going back higher tariffs. Things will get a little bit worse from here, not necessarily better. And that's why from a risk-reward perspective now, it starts to make sense to build that short position on. Okay. Moreover, don't forget, and this is key, uncertainty is the narrative now. Uncertainty is the theme. The Fed told us last week they ain't going to be cutting anytime soon. And they are still very, very uncertain because what's going to happen over the next 90 days? We just don't know. Nobody knows. So who's going to go and take risk now and take cash out of the market and put it to work at these levels once we've rebounded and traded back the entire range? Okay. The market's going to wait for more certainty before it's going to get to work putting cash into the stock market. Okay, now where's this wrong? Well, look, if you're going to start closing above 5,900, fine. That thesis is wrong. But what are we talking about here? We're talking about 60 to 100 points, call it 1.5 to 2% stop in terms of whatever the downside might be. Okay, like I said, things get potentially worse from here rather than better in the near term, particularly over the next 50 days as we start to see deals and terms of deals coming through. Okay, and this is kind of a great article from Mike Dolan. You can go read it. Again, talking about this, peak uncertainty situation and ultimately how over the last 2 months, yes, we had a lot of recessionary fears. That's now starting to fall away. But the key, this last line is the real key. Few investors are confident about the eventual economic and inflation fallout. Okay, and I think the key to take away from this is right now, the whole tariff sort of news cycle, that was important, pretty much for the whole of, March and April. However, if you look at how the markets have traded over the last, couple of weeks, they've desensitized to the whole tariff situation. Okay, in other words, the news flow and the new narrative is now going to be about the data. And, ultimately we know the Fed's data dependent, but now the market's going to start looking very closely at the likes of, retail sales this week, at CPI, which comes out tomorrow. The market now wants to know what are the implications at a hard data level. Okay, don't forget, hard data is very much lagging. The damage is already perhaps done in March, April in terms of sentiment. We know that. So now we need to see, does that filter into the data or not? Okay, in other words, who's going to put money to work as an investor right now once we've rebounded and traded the entire, sort of liberation day back? Very, very few institutional investors. Okay, they're going to wait for more clarity, and that's not coming in the next 90 days. And let's look at a couple of markets. I think Dixie's a key one, and this kind of really points to this idea of investors are uncertain. Okay, there's the Liberation Day. You can see we're still 3.5%, 4% below that. What does that tell you? Well, no one's flooding back into the dollar. Okay, could the dollar continue to grind higher? Yes, I expect it might do. But does that mean uncertainty's gone? No, absolutely not. Okay, if we were going to go like for like versus the US stock market, the dollar should be all the way back at that 107 level. Okay, we're about 6.5% below that. The point is that right now investors are not just flooding back into the plays they were at the start of the year, and that's because there's a very, very high degree of uncertainty still. Okay, with that in mind, I think the euro is an interesting one. It's done some technical damage over the course of the last couple of days. It is a market that's still structurally very, very bullish. Like I said, it's got two tailwinds. Europe, one is of course the big fiscal spending package, and the other is of course Europe is now seen as an investment destination. But like I said, some technical damage has been done. We're back below that 112. I do expect that over the next couple of days we'll filter our way back towards that 110 level. Keep an eye on that. I think that should be a good time to start buying up the market again. Because don't forget, I think structurally things have changed somewhat this year for the euro. Now, moving forward to gold, I think this is going to stage a little bit of a multi-day sell-off. Why? Well, if you cast your minds back to last week's daily market rundown, we spoke about the key drivers of gold. One of them, of course, was the risk-off sentiment. Okay,
that's why
gold is down today, over $100. You know, call it 3 and a bit%. It is very much a little bit of that risk-off, sort of safe haven coming out of the market. But the other two key issues for the gold market in particular is we are now going to see a little bit of a bid come back into the dollar. Okay, so a combination of a better environment, a lower VIX, as well as a stronger dollar is not going to play well for gold. And don't forget, gold is still very, very overbought despite the fact it's down 3% today. Okay, so don't be surprised to see over the course of the next couple of sessions, I do think gold is going to make its way back down towards that 3,000 level, not because it's a round number, but because that's where we staged ultimately the Liberation Day from. Okay, Liberation Day initially started somewhere around that 3,100 mark. It initially sold off with equities and then rallied. Okay, I do expect that gets tested again somewhere in around that 3,000 level. I think you can buy the market up. Now, if we look longer term, that is the gold chart, and you can see gold has been on a rip, ever since, of course, Q1 2024. We were trading all the way down to $2,000, so we're up, call it 60% over the course of the last, not even just over a year. Okay, that is it doesn't matter what the market is, a 60% rally is always going to be tested, and I do suspect we get a little bit of a deeper correction this time around. If you just look at the charts in terms of 3,000, it's going to land somewhere between that 100-day moving average and the 50-day moving average. But like I said, I do expect a little bit of a deeper retracement this time, perhaps even as low as the 200-day moving average at some point, but not within this correction. Okay, gold is still very much a firm buy simply because of the fact that we are going to see a much hotter inflation cycle moving to the end of this year. Okay, so right now it's not like gold has ended this uptrend, but I do suspect a deeper correction is inbound, and I would not be touching this at least for another 7 to 8% correction. Okay, let's then turn our attention, of course, this week. We have got a number of data points out, some key data points, starting, of course, with the CPI dates tomorrow. That's going to be absolutely crucial for markets. We all want to know now, do those tariffs, are they going to have massive inflationary implications? How big a beat are we going to get? Are we going to get a beat? Are we going to get a miss? Okay, we've obviously seen 2 soft prints in the CPI in a row now. Should we get a miss? Well, yeah, that might be enough to ignite the stock market up the page for sure. But like I said, it's very much now going to turn to inflation. We can see, looking at bond yields, they are 16, 17 basis points higher since last week in the 10-year. So we're seeing higher yields in the back end. Should we get a big inflation number tomorrow? Again, that's going to create the next new narrative, which is how on earth is the US going to fund itself, with a 4.5 to 5% 10-year yield? So that could be a narrative that starts to take shape over the course of this week. We do have PPI on Thursday as well as US retail sales, which will be very closely watched. And of course, we've got Chairman Powell up this week, which of course could be very interesting to listen to. That is a wrap then for today. If you have any other questions, do post them in the Discord channel. Otherwise, good luck out there, manage the risk, go make some money.